The Alpha Horizon. Thinking different. Acting aware.
Hello and welcome to the latest episode of the Alpha Horizon podcast from Algebris Investments. My name is Douglas Branson and I'm Head of Business Development at Algebris. I'm joined again today by Alberto Gallo, who is our Head of Global Credit and manages a strategy focused on global credit opportunities. Alberto and his team write a regular commentary entitled The Silver Bullet, which is available on the Algebris website, and I would urge you to read this for insights on the global macro and investment environment. In the podcast that Alberto and I recorded in June, we talked about the outlook for the rest of the year and the fact that investors generally seemed comfortable in terms of improved sentiment, healthy macro data, and decent performance for risk assets over the course of the first 6 months of the year. The strong message was really that while there were reasons to be positive going into half two, investors should expect high levels of volatility and to be prepared to ensure that they are positioned with the appropriate level of cautiousness for the rest of the year. Now, since the start of the year, economies have recovered more quickly than expected, and the rhetoric from central banks has been focused on not removing monetary and fiscal stimulus too soon. Markets seem comfortable that this is genuine and that inflation is indeed transitory. But there is an underlying feeling that inflation may be more persistent given price increases in certain areas and upcoming supply bottlenecks in other areas. So the two topics that are front of mind currently are inflation and China. And with this in mind, Alberto is going to talk through his thoughts on the overall environment, inflation, China, and lastly, comment on portfolio construction. So Alberto, thank you for your time. Perhaps we can start with your thoughts on how the macroeconomic environment has developed since the start of the summer. How concerned should we be that economic data releases are weaker now, and how concerned should we be about inflation?
The global economy has gone through a very strong fiscal and monetary stimulus. Governments in the West spent between 5 and 20% of GDP since the start of the pandemic in fiscal stimulus, which includes a variety of initiatives from supporting incomes and helping people to pay rent to new infrastructure programs, both in the US and in the Eurozone. On top of that, central banks lowered interest rates to record lows and initiated purchase programs across government debt and in some cases also corporate debt. And these programs are still going on as we speak. The ECB is buying around 80 billion euros of bonds every month through the pandemic emergency purchase program, and the Fed is buying $120 billion of debt as well every month. The question is, when do you take the foot off the pedal? Today, the economy is reopening. We just heard from President Biden that there's a plan to reopen transatlantic travel. The majority of adults in Europe and the US are vaccinated. And yes, there are still countries that unfortunately are lagging behind, but we are in a reopening environment. So the worst is behind us, and the question is how governments will decide to curb on fiscal stimulus and central banks might decide on reducing monetary policy. The result is going to be a very gradual reduction in both fiscal and monetary stimulus. This is likely to leave interest rates both in the short end and in the long end of yield curves, below the level of inflation, which means negative real yields. There are some dangers around this. Obviously, it is dangerous for the economy and for central banks to withdraw stimulus too early. But there's also a danger in leaving a stimulus and the punch bowl available for too long. And that danger is that with negative real rates, you can fuel mispricing of assets, you can fuel asset bubbles, and you can have the economy overheat.
Understood. Thank you. So what are the primary messages from recent central bank meetings? Are they laying the groundwork for a reduction in stimulus?
We could actually divide central bankers in two groups. There are the ones that are more worried about inflation in economies that are driven more by commodities. And we know that commodity prices have gone up between 20% and over 100% in the last 18 months. So, for example, the Central Bank of Canada, of Russia, of Mexico, these central banks are a lot more worried about a rise in inflation. And also some European central banks, like in the Czech Republic, have been a lot more hawkish. But if we look at the main developed market central banks, the Fed, the ECB, the Bank of England, the Bank of Japan, they are still very much in the dovish camp, despite signs of rising inflation. And these signs of rising inflation are particularly strong in the US and the UK, where you have a combination of strong consumer demand. Consumers want to spend more or as much as before the pandemic, together with supply bottlenecks. So the big debate is about whether these supply bottlenecks are transitory or not. Some of them are definitely transitory, and they are deriving from disruptions in the supply chain that come with the pandemic. So you might have certain shortages, delays in ports for the unloading of ships, and these things will gradually normalize. But there are also supply shortages and bottlenecks, which are a lot more persistent. The Intel CEO has, for example, said that there's going to be a 2-year period at least to absorb the chip shortage. And strategic goods like semiconductors have to be produced more domestically as the conflict and the tensions between the US and China continue to persist. So in a deglobalization environment, companies can no longer rely on a just-in-time delivery supply chain and on outsourcing for lower prices. On the other hand, what we have is an increase in redundancy, or increase in domestic production, and an increase in costs. Adding to this and making the supply chain more volatile and more disrupted is climate change. Some of the producers in semiconductors, for example, were disrupted by a drought. There is lower winds in Europe, and that has meant that the UK had to deliver power through burning coal, for example, which is more expensive and also more polluting. So volatility in climate, which is rising, also means volatility in input prices. So far, inflation has been deemed as a transitory phenomenon, but we are seeing that gradually there is a rise in expectations. The New York Fed reports that 1-year inflation expectations are now over 5%, and 3-year inflation expectations are around 4%. So clearly, consumers' mindsets are changing. In the UK, inflation is already real because of Brexit-induced supply bottlenecks. For example, RPI, retail price inflation, is 4.8% in the last print year on year. So our view is that, yes, some bottlenecks are transitory, but it's very hard to say that inflation will completely disappear. And more likely, we think it's going to normalize at a level that's higher than pre-COVID. Today, central bankers are very relaxed, but tomorrow, next year, they'll be a little bit more challenged in their dovish approach.
So look, it's an interesting week for us to be recording a podcast, given how risk assets have been performing in recent sessions. And clearly what's going on in China is impactful, but is this the only reason for the sell-offs? And do you think that the problems with Evergrande can become systemic?
One very interesting point here on China is the Chinese policymakers are essentially trying to solve similar problems to the ones that we have in the West. We've used for a lot of years credit and debt to boost growth. In China, it was called total social financing, and in the US or Europe, it's government debt. But governments have used leverage, public and private, to boost growth. We have a society that's grown unequal because of lower interest rates that have boosted wealth. And so inequality across society is a problem, but also inequality across companies. Large companies can fund in the bond market at 0 rates thanks to QE, and they have very big advantages. There's also asset bubbles, which endanger financial stability, but also make it very hard for some parts of the population to access property markets or buy what they need. And so with the common prosperity message that China and the Premier Xi Jinping has delivered, the idea is to restructure the economy, and the Chinese policymakers are essentially tackling the same problems that the West has, but in a very, very different way. Instead of giving the patient a broad-based anesthetic, a one-size-fits-all measure, which is quantitative easing or lower interest rates, they're acting more aggressively, more surgically to solve the problem with micro-structural solutions. So Evergrande is a government-induced problem. The government in China has, in June, started a policy of the 3 red lines of essentially sanctioning property companies that would have more than a certain amount of debt to assets, more than a certain amount of debt to equity, and less than a certain amount of cash versus short-term liabilities. Evergrande was one of the most levered firms, and so large it had over 2 trillion in debt in CNH, and expanded to a point where it was not only in property but also in businesses from electric vehicles to bottled water. The company itself has employed over 3 million people in China across all these different businesses. Is it systemic? Well, our base case is that Evergrande will restructure debt. This is not a new thing to markets. Evergrande bonds have started to trade at very discounted levels. But it's also very likely that the Chinese government will intervene to manage the spillovers from Evergrande. Let's remember that the property sector accounts for around 15% of China's GDP directly and 20 to 25% indirectly. And that Chinese people, on average, for the average household, has around half of its wealth invested in property. So for political reasons and to show the new direction of the party, let's remember next year we have a National Party Congress. And China wants to show that leverage is not a good thing, that common prosperity means that housing is for living, not for speculation, and that you cannot speculate and make oversized profits. So Evergrande is the case in point for teaching a lesson to speculators. And it is a story that will serve for the purpose of reducing leverage across the sector. But we do not think that the country is doing this to self-induce a property recession. On the other hand, it is very possible that the measures that China is implementing might be actually better than doing QE or lowering interest rates without structural action, which is, for example, what has happened in the UK or the United States so far. And finally, common prosperity includes improving access to education, reducing monopolies, a number of things that are aimed at improving productivity. So while in the short term there is market pain, all these actions actually make me want to be more bullish about the prospects for China growth and reflation, besides this hiccup, which we have, by the way, seen in many instances in the past with other companies.
Great. Okay, thanks, Alberto. And just moving to the last question, can you talk us through how your strategy is positioned currently? And just add to that, one question I always ask you is, what do you feel is most important in terms of portfolio construction over the next 1, 3 and 5 years?
So thanks, Doug. I would say two things. The first is that probably government yields will remain low and similar or lower than inflation levels. And this means that now generating alpha in fixed income is a must-have for investors. It's no longer a nice-to-have, which means that we need to be innovative, we need to potentially take bigger risks when the time is right, and we need to have a strategy that generates alpha across bonds. It's not enough to just buy any bond index because interest rates are going down and the whole market is going up, as it happened in the last 20 years. Today, we have very low bond yields. They don't compensate for risks in many assets, and they don't compensate for inflation. So the risk-free rate, the positive risk-free rate, is a casualty of the pandemic, and governments will have to impose financial repression, impose a tax on savers, which in the case of the US and the UK, can be as high as -1%, -2% per year. Accumulated over 10 years, that's a lot of money that goes away, eroded by inflation. So where do we find value? We want to find value in a variety of credit assets, including high-yield debt, including emerging market hard currency debt, and very selective emerging market local debt. But also, we construct a portfolio in a much more barbelled way. In other words, with central banks having been the only game in town, the traffic light that was driving markets for so long, what we are increasingly seeing is that when that traffic light turns red, there's nowhere to hide. So both risk-free and risky assets go down in tandem. And as a result, if you have a 40-60 bond equity portfolio, that no longer really works. You cannot longer assume that there is a negative correlation in price, between bonds and stocks. And for this reason, our portfolio is constructed in a much more barbelled way. We have risky assets and we have hedges, protection against a fall in risky assets. And then we have liquidity, which is potentially a simpler way. And in our strategy, even though we think a lot about portfolio construction, we think a lot about macro, what we do in the end is finding the best 100 ideas across sovereigns, corporates, and banks, and generating a yield above inflation, and looking for catalysts for our bonds or our securities to appreciate. Finally, one last word on convexity. In a world where a lot of bonds essentially give the investor a few cents in exchange for a lot of negative price downturn if things go wrong, so very adverse convexity, very adverse upside downside, we always look for opportunities which are rare, but opportunities that have the same amount of upside than downside. And those can be found in some selected credits as well as in convertible debt. So if I have to summarize, our recipe is very simple portfolio. In the end, we have 100 issuers across sovereigns, banks, and corporates. It's barbelled. So we don't bet on the fact that the correlation might have been negative in the past, because it's turning positive as inflation goes up, as sovereigns become less risk-free, and very selective and concentrated on ideas that have at least the same amount of upside than they have downside, so positive convexity for investors. If central banks have skewed the odds against investors in the bond market, what we try to do is to rebalance them in your favor.
So that just leaves me to thank Alberto for his time and to thank our listeners. As mentioned at the beginning of the podcast, please visit www.algebris.com for further insights and search for the most recent Silver Bullet commentary entitled China's Long-Term Game. As always, we hope this has been informative and useful, and we look forward to continuing the regular edition of the Alpha Horizon podcast from Algebris Investments. Until next time.
The Alpha Horizon. Thinking different, acting aware.